IFRS, voila, you are IFRS. So we have exactly picked up, thank God, and put it here, which is perfect. So all this language is from there, but it is all the same. Therefore, don't get carried away, just go to the simple meaning of that. Independent and combined, now we're talking of those two aspects, separable. What's the meaning? An acquired intangible asset is capable of being separated or divided from the acquiree, that is from the person who you, and then it can be sold, it can be transferred, it can be licensed, it can be rented, exchanged, whatever. So it is identifiable. Now, that's a different question, whether after the acquisition you really want to sell it off or transfer it or to keep it and run the business. That is not the question. The question is whether it is identifiable separately or not. So that why are all these questions coming in, please understand, because the fair value of each one of them depends on that. If it was combined, it would be a different way of doing fair valuation. If it's single, it's separate, it's a separate way of doing fair valuation. So that's why these differences. Otherwise I would have just said one identifiable asset, just put brand value or brand. It's not that way, so you have to break it down. Now, people would have heard in the software industry or in any other industry also of customer and subscribe lists. These are frequently licensed and therefore they meet the separability criteria. Customer list. What is a company interested in when the acquisition is happening? It's the customer list that you have. And that was never there on the balance sheets, right? Now you have customer lists on the balance sheet. In which way? So even if an acquirer believes his customer lists have characteristics different from other, the fact that these are generally licensed means that the acquired customer list meets the separability criterion. You need to, when you go for an acquisition, you're actually seeing, okay, do you service A, B, C? Are those of your interest? Is there a synergy? You want to see how you want to do, and therefore you price it. Now, but a customer list acquired with business combination will not meet the separability criterion if the terms of confidentiality or other agreements prohibit it. So you have to, just because the word customer list I told you and you went and found I have got Hindustan Lever as a customer, okay, let's put it up on our balance sheet and big identifiable asset. No. You have, everything has a caveat. So you have to look at confidentiality, you got to look at things, whether you can use it or not, whether it can be done or not, whether it is subtle. So it's a matter. Therefore, how many of you are lawyers in this room? Full-fledged? 1%. Okay, good. The reason why I ask this question is, you should have the flair to read the agreements. Because now I'm stepping into the shoes of an auditor. If I'm an auditor and partners will not be moving everywhere, so the team which moves, you give them an agreement of 250 pages, they will just write the name of the company and come back, the article trainee, and they said that we got this agreement. Okay. This is what you've got to read and find out what happens. So therefore, even if you're not a lawyer, so what? You have to read, right? Nobody's going to go and write exams now. I'm still writing. I'll share that with you later on. But this is readability. So that is why I started the session with saying, this is my Bible for the session today, and I read it, and you have to do it, because otherwise you'll never get to the essence. Even a simple agreement, forget all the big companies. Say if you're talking to mid-sized companies, okay, let's face the fact that everybody doesn't do. So we have mid-sized, but even mid-sized companies have agreements. You need to decipher these aspects in an acquisition specifically. So that's where I'm saying this makes a lot of sense. Now this is an example of a combined intangible asset which is not individually separable. The example is there of a registered trademark and documented, but an unpatented technical expertise to manufacture the trade product. Now to transfer the ownership of this, the owner is required to transfer everything else necessary for the new owner to therefore produce those products. So because these are non-separable, but they still are combined, they meet the test of a trademark, which you can, and you will still identify it separately. So the idea is that you have to look and find out whether there is a separable or a combined intangible asset, not a non-identifiable one. The moment it is non-identifiable, it goes and sits in the goodwill. So you will have a fat goodwill still if there are many non-identifiable intangible assets. So these are the non-identifiable intangible assets as a little help to you. Read the terms. Assembled workforce. Potential contracts. Potential contracts today, at the time of an acquisition, would anybody pay for, would anybody pay a consideration for this? I'm talking about buyer, a willing buyer, a willing seller. The yes was so small, so still very small. So others are no? No, the others are not no. But the yes is still a very, yes, so obviously you would, if answer is not a yes, yes, it is possible that you will pay. But whether you will be able to decipher the price, quite difficult. Quite difficult. That's why it's non-identifiable. So in the overall scheme of affairs, because the seller will show himself to be the best seller in the world and say that, okay, this is also potential and that is also potential and everything is potential, but today I've got nothing. So you got to see that with that pinch of salt. So these are non-identifiable synergies. Of course, the acquisition has happened because of a synergy, but do you bring a synergy on the balance sheet? That's one. Oh yes, the high credit rating. Everybody says AAA, then tomorrow everybody will start getting those certificates the moment it becomes identifiable. Okay? Today it's just a tag. You can't have anything like this because it can change from in the next month. The rating can change. Now, this is important. Everything is important, but this is super important.
So, because of this synergy, there is a chance that you are going to save much taxes, and you have the value that, okay, I will save 1 or 2 crore taxes. You have the value.
That's built into your pricing, into your negotiation, which will be from a asset versus stock sale. Your concept that if you start